I'm going to go into the fundamental, historical analogous, seasonal, technical. I'm going to create a scenario for the price of oil, and then I'm going to create a trade plan. So this is a theme that's going to take a little while. This video is going to be, 20, 30 minutes long. Okay, the first thing that we're looking at here is what's called the term structure. The term structure. So in effect, it's like the yield curve, only for crude oil. Up at the top is Brent, down at the bottom is WTI, West Texas Intermediate. You can see that there's a downward slope, and what each one of the colored bars is the expiration of a futures contract. So the futures contracts that are going to expire soon are on the far left, and on the far right is where there are futures contracts that are going to expire in a couple of years, okay, in 2024. So we can now see that the nearby futures are much higher priced than the futures in the future. Now, what does that mean? Normally, it costs money to store oil, but the futures market is penalizing you for storing the oil. They're saying, we'll pay you more if you give us the oil now than if you store it for another time. So what that means is, that means that the supply and demand of oil is bullish. They're going to penalize you for storing it. They'll pay you less if you hang on to it. What the market is saying is, give us oil now. We're short of oil right now. We'll pay you a premium if you deliver it now. This is the single best way to determine what the supply and demand is, or the supply-demand balance is for oil. So this chart is clearly bullish.